Will this media giant maintain its corona-fueled momentum? Well, my name is Andrew Stotz, and this is Uncovered Asia, where we're exploring interesting stocks in Asia that are not covered by institutions and analysts. The company today is PT Global Mediacom. Remember, this is not a recommendation. This is just me fiddling around. It's Indonesia's largest media company, and it is listed on the Indonesian Stock Exchange. So what's the core business of this company? Cable TV stations and subscription-based streaming businesses, and then several digital businesses. So let's look at MNC, this Media Nusantara Citra cable TV stations. And here we can see that free-to-air TV stations, and they produce some of Indonesia's hottest shows. Next is MSKY, which delivers a subscription-based streaming service with 137 channels. They've got news, sports, comedy, all of that. They have 70% of the streaming market in Indonesia. Powerful. Then there's the digital businesses like online news, TV shopping, e-commerce for fashion. And they also have something called MeTube and Mr. Aladdin, video sharing platform and online travel. Now the revenue breakdown, you can see, is coming mainly from the cable TV, but the subscription-based revenue is 29% and growing. Now, recently I've seen the stock price of this company move. It's up 57% over the past 3 months. You can see the volatility is very high, particularly relative to the overall market. So the question is, can this price rise be sustained? Let's look at it. Well, I use a tool that I developed called world-class benchmarking, which helps me identify a company's competitive position relative to global peers. I use a combined composite score or rank of profitability and growth, and I call it profitable growth. I consider a company over 5 years, and PTM means the past 12 months. That's a rolling 12-month average of the latest quarterly results, from a scale of 1 being best, number 1, to 10 being worst. If you want to learn more about it, you can see in the video's description below. Now, what do I find? Well, the company's profitable growth score is above average at a 4. That's compared to 1,120 consumer discretionary companies worldwide. So it's above average performance. What's also nice is it's been improving steadily from a 6 to a 5 to a 4. That kind of fundamental momentum is great for share price. So where is that profitability coming from? The profitable growth coming from? Well, it's coming from profitability, which is improving from 6, from 8, even you can see 10 to 8 to 6 to 5 to 4. What is it about profitability? Profit margin is very strong. Growth is about average in 2019 and for the past 12 months. The company's weakness is asset turnover, but it's definitely got strength in the net profit margin area. So the next question I want to think about is this stock worth considering to do more research on, to consider buying it or investing in it? The way I start to assess that is I start off with my FVMR scorecard. And this considers a stock's investment attractiveness relative to stocks in that country or region. This attractiveness is based upon 4 elements: fundamentals, valuation, momentum, and risk. It considers the company also over 5 years, and I use a scale of number 1, best, to number 10, worst. You can learn more about FVMR below. So let's look at the company's FVMR scorecard. And here we can see on the fundamentals, it's average performance. It's got stable margins, not bad. Asset turnover is a little bit low at 41, and that's part of the weakness of the company. But profit margins have been strong, and ROE is strong and steady. The next one is valuation. The company is relatively cheap compared to its peers. And if we look at momentum, we can see that it's got strong price momentum, and also there's been some good fundamental momentum. Finally is risk. Now risk, it's ranked a little bit more risky than the average. Part of that has been its level of debt. Its debt, net debt to equity was up at 156 at its peak. Now it's down to 76. So we're starting to see some reduction in debt there. But volatility is still high with a beta of about 1.3 over the last 3 months. So why the price rally? Well, The majority of revenues come from cable television and subscription-based streaming. It's an excellent company, an excellent play in this COVID pandemic situation. And according to a recent study in Indonesia, COVID has increased media consumption by 60%. Hey, even I'm sitting around watching Netflix at night. My goodness. So certainly this benefits this media giant. So I'm going to wrap up by asking you the question, will this media giant maintain its corona-fueled momentum? Let me know your opinion in the comments.